After studying this module, we shall be able to highlight the difference between the capital structure approach with corporate taxes but without personal taxes and capital structure approach with corporate and personal taxes. We shall also be able to show how the value of the interest tax shield will get affected by personal tax rate. And finally, we shall also discuss how this value of INTS will be beneficial for the debt holders of the firm and hazardous for the equity holders.
Miller and Modigliani derived the theorem and wrote their groundbreaking article when they were both professors at Graduate School of Industrial Administration of Carnegie Mellon University. The story goes that Miller and Modigliani were set out to teach corporate finance for business students despite the fact that they had no prior experience in corporate finance. When they read the material that existed, they found it inconsistent, so that they sat down together to try to figure it out. The result of this was that the article in the American Economic Review and what has later been known as the M&M theorem. Miller and Modigliani published a number of follow-up papers discussing some of these issues. The theorem was first proposed by F. Modigliani and M. Miller in 1958. Consider two firms which are identical except for their financial structures. The first firm, assuming firm U, is unlevered, that is, it is financed by equity only. The other firm, assuming firm L, is levered. It is financed partly by equity and partly by debt. The Modigliani-Miller theorem states that the value of the two firms is the same. The tax advantage on debt proposes that a firm can increase its value by increasing debt, and thus value can be maximized if entire amount of debt is employed. But still, firms do not employ 100% debt in their capital. The reason is existence of personal taxes. Although the firms get benefit of tax exemption, but investors have to pay personal taxes on their interest income. Thus, with increasing leverage, the amount of personal taxes also increases, which offsets the advantage of interest tax shield. Thus, we can say that in the existence of both corporate and personal taxes, firm's objective is not to minimize corporate taxes alone, but the total of corporate and personal taxes and to minimize the net income of the investors after corporate and personal taxes.
In this module, we shall discuss the MM preposition in the presence of the corporate as well as the personal taxes. Let us first of all discuss the impact of these taxes on the income of investors with the help of an illustration. Let us consider a company whose operating income is rupees 100, which can either be distributed as dividends or as interest. The corporate tax rate is 50%, personal tax rate on equity income is 30%, and on debt income is 40%. As companies have to pay taxes on dividends and personal taxes are also imposed, the net dividend income will be calculated after taking into account both the taxes. Thus, the net dividend income comes out to be rupees 35 as shown here. As in case on debt, the interest is tax deductible. However, personal taxes are imposed. Therefore, the net interest income will be rupees 65 as shown here. We have just seen that the net interest income is more than the net dividend income. Thus, it is beneficial for the investors to invest in debts. This extra income is due to the savings of corporate tax on interest income. It is called net tax advantage. In our illustration, it is equal to rupees 25. Thus, we can conclude that the net tax advantage can be calculated by the formula as shown here. As the net operating income is same in both the cases, we can say the net tax advantage mainly depends upon corporate tax rate, personal tax rate on dividend income, and personal tax rate on interest income. We will now take two cases of personal taxes and see how tax advantage works.
The firm will go for more debt till net tax advantage is positive and stop using more debt when this advantage becomes zero. As corporate tax increases, the tax advantage of debt increases and debt becomes more valuable and vice versa. As personal tax on equity increases, the net dividend income falls and thus debt becomes attractive and vice versa. As personal tax on interest income increases, the net tax advantage goes down and it becomes less attractive to go for debt and vice versa. If there are no personal taxes, that is, if they are zero, then net tax advantage only depends on corporate tax rate. Now, we will discuss how this net tax advantage increases the value of a firm. We will consider two cases for this. Case 1. Equal personal taxes for equity income and interest income. Case 2. Unequal personal tax rate for equity and interest income.
The first case is when personal tax rate for dividend and interest income is same. Thus, there is a common personal tax rate. In this case, the net tax advantage is calculated by the formula as shown here. And the net tax advantage will depend only on the corporate tax rate and the personal tax rate. Let us take an illustration to make it more clear. Suppose there are two firms U and L. Firm U is an unlevered firm and firm L is a levered firm. The net operating income for both is rupees 2500. Firm L has rupees 5000 10% debentures. The corporate tax rate is 50% and personal tax rate is 30%. After working out the calculations as shown here, the net income to investors after tax comes out to be rupees 875 in case of firm U and rupees 1050 rupees in case of firm L. It is very much clear that due to the tax advantage of debt, the net income is higher in case of levered firm. The net tax advantage is the difference of net incomes of the two firms and is also called interest tax shield. It comes out to be rupees 175, that is, the extra income of investors in the levered firm is rupees 175. We can also calculate the relative tax advantage, which is the ratio of the net incomes in the two cases. It comes out to be 1.20. It means the investors are able to earn 1.2 times more income if they invest in the levered firm as compared to unlevered firm.
Thus, we can see that there is a positive tax advantage when debt is employed. Thus, debt increases value. However, if we compare this advantage with the illustration in the presence of corporate taxes only, we can see that the net advantage has gone down, but relative advantage is the same. Thus, personal tax affect net advantage but not relative advantage. In this case, interest tax shield is equal to KD into D into T 1 minus tax rate. From the calculations, it can also be concluded that the net income of the levered firm is equal to net income of the unlevered firm plus the interest tax shield. Net income of levered firm is equal to net income of unlevered firm plus interest tax shield is equal to rupees 875 plus rupees 175, which totals to rupees 1050. On the basis of this net income, values of the two firms will be calculated. As the value depends upon net income, it can be concluded from these equations that value of levered firm is equal to value of unlevered firm plus value of interest tax shield. VL is equal to VU plus present value of interest tax shield. VL minus VU is equal to present value of interest tax shield. Thus, value of levered firm will be higher than the value of unlevered firm, and the difference is equal to the present value of interest tax shield.
Now, we will compare the value of levered and unlevered firms. Since the interest tax shield is the difference between the income of investors of levered and unlevered firms, it can be said that the value of the levered firm is the sum of the value of unlevered firm and value of interest tax shield. That is the present value of interest tax shield, which is the product of corporate tax rate and amount of debt.
A tax shield is the reduction in income taxes that result from taking an allowable deduction from taxable income. For example, because interest on debt is a tax deductible expense, taking on debt creates a tax shield. Since tax shield is a way to save cash flows, it increases the value of business, and it is an important aspect of business valuation. A reduction of taxable income for an individual or corporation achieved through claiming allowable deductions such as mortgage interest, medical expenses, charitable donations, amortization and depreciation. These deductions reduce taxpayers' taxable income for a given year or defer income taxes into future years. Tax shields vary from country to country, and their benefits will depend on the taxpayer's overall tax rate and cash flows for a given tax year. For example, because interest on debt is a tax deductible expense, taking on debt can act as a tax shield. Tax effective investing strategies are a cornerstone of the investing for high net worth individuals and corporations whose annual tax bills can be very high. The ability to use a home mortgage as a tax shield is a major benefit for many middle class people whose homes are a major component of their net worth.
Let us now consider the second case. In this case, personal tax rate for dividend and interest income are different. The net tax advantage in this case will depend on the corporate tax rate, personal tax rate for dividend income, and personal tax rate for equity income. Let us consider an illustration to make it more clear. There are two firms, U and L. The net operating income for both is rupees 2500. Firm L has rupees 5000 10% debentures. The corporate tax rate is 50% and the personal tax rate on equity is 10% and on interest income is 30%. Let's calculate the income of investors and net tax advantage. The net income to the investors after taxes come out to be rupees 1125 rupees in case of unlevered firms and rupees 1200 in case of levered firm. It is very much clear that in this case also the net income is higher in case of levered firm. It is because the tax saving of debts are more than the higher personal tax on interest. The net tax advantage on interest tax shield is the difference of the net incomes in two cases, that is rupees 125 in our illustration. We can also calculate the relative tax advantage, which comes out to be 1.11. Now, we will compare the value of levered and unlevered firms in this case. As we discussed earlier, that the value of levered firms is the sum of the value of the unlevered firm and the value of interest tax shield, which is the present value of interest tax shield. As the interest tax shield is calculated differently in this case, its present value is also different. The present value of interest tax shield in this case is given by the formula as shown here. The present value of INTS comes out to be rupees 1786, which is lower than the previous amount of rupees 2500. Thus, the value of INTS get reduced. In this case, the personal tax rate of equity income is less than that on the interest income, because the benefit of the tax advantage of debt is crowded out by the higher interest on the debt income. Now, let us move on to another version of approach. This is the Miller's model. This model assumes presence of both corporate and personal taxes. It also assumes that the personal tax rate on dividend and interest income is different. This model focuses on the calculation and the comparison of the value of the levered and unlevered firms. Thus, we will now calculate the value of unlevered firm and present value of interest tax shield and thereby the value of the levered firm.
In earlier sections, we have compared the value of an unlevered and a levered firm in two cases. One, where there are no personal taxes, or the personal tax rate on equity and interest income is the same. The result says that VL is equal to VU plus present value of interests. The Miller's model focuses on calculation and comparison of the values of levered and unlevered firms. In a case when the personal tax rate on equity and interest income is different. Value of unlevered firm. Value of firm is calculated as its net operating income after all taxes divided by the cost of capital after taxes. The net income of unlevered firm after all taxes is given as unlevered firm's income after all taxes is equal to NOI 1 minus T 1 minus TPE. As this income is earned After considering corporate and personal taxes, the discount rate also considers the effect of personal taxes. Therefore, cost of equity is equal to KE 1 minus TPE. Thus, VU is equal to NOI 1 minus T into 1 minus TPE divided by the KE 1 minus TPE value of levered firm. The equity income of the levered firm is first calculated after subtracting interest income, and then interest income after tax is added back to arrive at total after tax income. Thus, total after tax income or the levered firm is given as levered firm's after tax income is equal to after tax equity income plus after tax interest income, which is equal to NOI 1 minus T into 1 minus TPE plus KD into D 1 minus TPD minus 1 minus T into 1 minus TPE. Thus, the total income after tax or of levered firm is equal to the income of unlevered firm plus interest tax shield of levered firm. Thus, the value of levered firm can be calculated by dividing the two terms with their respective discount rate, that is KE into 1 minus TPE for income of unlevered firm and KD 1 minus TPD for interest tax shield. Thus, value of levered firm will be arrived at, which will be equal to NOI 1 minus T into 1 minus TPE divided by KE 1 minus TPE plus KD into D 1 minus TPD minus 1 minus T into 1 minus TPE divided by KD 1 minus TPD. Therefore, VL is equal to VU plus 1 minus T into 1 minus TPE divided by 1 minus TPD into D. Thus, it can again be concluded that the value of levered firm is equal to value of unlevered firm plus present value of interest tax shield. Following result can be drawn from the relationship. If there are no personal taxes, that is TPD is equal to TPE or both are equal to 0, then VL will be equal to VU plus T into D. Thus, value of interest tax shield depends only on T, which is corporate tax rate. If personal taxes on equity and interest is the same, that is TPD is equal to TPE or both equal to TP, then VL will be equal to VU plus T into D. If personal tax on interest is greater than on equity, then the present value of interest tax shield will be less than TD, as higher tax rate on interest will offset the advantage of interest. If personal tax on equity is 0, then present value of interest tax shield will be equal to 1 minus T divided by 1 minus TPD and the entire multiplied by D. The value of interest tax shield depends only on corporate tax rate and personal tax on interest. This value of interest tax shield will become 0 when corporate tax rate is same as tax on interest, that is T is equal to TPD. If 1 minus TPD is equal to 1 minus T into 1 minus TPE, then the value of tax advantage will always be 0.
We know that the value of unlevered firm is calculated by dividing the net operating income of unlevered firm after taxes by the cost of equity. The net operating income after taxes can be calculated by subtracting the corporate taxes and the personal taxes on equity income. The cost of equity is the cost of equity after taking into account the personal tax rate on dividend income. Thus, the formula for the value of unlevered firm can be worked out as shown here. Now, we come to know the value of levered firm. It is calculated by dividing the net equity and dividend income of levered firm after taxes by the cost of equity after taxes and cost of debt after taxes respectively. Thus, the value of levered firm can be calculated by the formula given in the equation A. On further solving out the equation, we can say that the value of levered firm is the sum of the value of unlevered firm and present value of the interest tax shield. After calculating the value of levered firm, the question arises as to what should be the optimum level of the leverage in a firm. The equilibrium level of the leverage in one which maximizes the value of the interest tax shield, the one which gives maximum benefits. Here, we assume that the personal tax rate on the equity income is zero. Thus, the present value of the interest tax shield can be reworked as shown here. As a firm uses debt, it enjoys tax savings. But the investors prefer equity income as it is the tax exempt for them. Thus, the firm has to pay the investors higher interest to cover the tax that they have to pay on interest income. Initially, the benefits will be more than the interest paid, but subsequently it gets reversed. Thus, the equilibrium is said to be achieved when net tax benefit is zero. That is, the tax benefit is same as the personal tax rate on the debt. We can also say that this situation takes place when demand for debt and supply of debt are equal.
Miller's model is criticized for various assumptions it makes. The model assumes that investor is in no taxable income range would go for debt and investors in tax brackets would prefer equity only. But investors generally prefer a combination of debt and equity both. This model also assumes 0% tax on equity income. But in some countries, investors have to pay tax on their equity income as well. Thus, more investors can be attracted towards debt. Investors can also be induced to invest in debt indirectly. They can invest in tax exempted institutions which can further invest in corporates.
In this module, we have discussed the approach in the presence of corporate and personal taxes, the Miller's model, and the equilibrium level of the leverage.
Let us now recapitulate what we have learnt in this module. Miller has proposed a theory which shows the effect of both corporate and personal taxes. According to this theory, the benefit of interest tax shield is offset by personal taxes paid by debt holders on their interest income. Interest income is exempted from tax at corporate level while dividend income is not. Interest income is taxed at personal level, while dividend income may largely escape personal taxes. Thus, companies can induce tax-paying investors to buy debt securities if they are offered high rate of interest. But after a stage, it will not be possible to attract investors in high tax brackets. Thus, there should be optimum combination of debt and equity for individual firms. It is very difficult to believe that corporate borrowing is not at all beneficial to the firms. This model assumes no taxes on equity income, but in reality, investors have to pay taxes on their equity income. Thus, investors can be attracted towards debt. Also, there are investors who lie in different tax brackets. Thus, tax advantage of corporate borrowing is partly taken away by lost personal taxes.